as I remind you time and time again, well, what happens? Well, unfortunately, policy changes, right? So if we were short heading into the weekend, and I was short on Lyft, obviously, with a couple of different trades, long on Kratos and long on a couple other things, you wake up, S&P 500 up another, whoop, there it is, 1.4%. Things looking a little stronger this morning, holding above that 200-day moving average. And we're going to talk about SMA and EMA this morning because there's a little bit of a lesson that I want you to have about breakout levels. So we have been talking about the SMA. The SMA is pretty standard across the board for a lot of different platforms. I want to bring in the EMA this morning and just show you the difference between the two because the EMA is better at focusing on short term than it is long term. And we'll dig into that and a couple other things. Hey, Joyce in Spain, I hope everything is in Spain going well. I guess that your power is back. That's good. What we're going to talk about today, once again, tune in, tune up, momentum, insider momentum. We'll talk about insider buying briefly, and we'll talk about breakout levels. So this morning, intraday measurements are improving from where they were on Friday. But again, there is obviously that undercurrent concern around the bond market. So yeah, you've got this pop over the weekend. Looks pretty good. I do just want to urge some caution in this environment. We have been very, very stretched going back to April 23rd. That was the last time that we had a momentum switch. And intraday has been a little bit weak. So again, keeping a very close eye on those momentum levels, 5,900. I kind of anticipated that we would stay in a range of around 5,800 to 6,000. I'm looking for that next breakdown. We're just not there yet. What looks strong right now, fuel cell, FCEL had a huge day. On Friday, so did CTLP, so did ALTS, ALTS. This was a kind of backdoor little company that we were watching on Friday morning. This thing screamed 23% on Friday. In addition to that, looking at FCX, Palantir, and Royal Caribbean. Once again, when momentum is positive, so typically are those cruise line stocks. So look at NCLH, look at Royal Caribbean, look at Carnival today. These will become very valuable volume-weighted average price trades. And if you haven't seen us talk about volume-weighted average price, go back and look at some of the videos that we've done on it. I am going to dedicate Friday this week to volume-weighted average price and trading it. Today's watch list, CTLP. Looking for a company that was kind of Cantaloupe, was in a little bit of a breakout pattern heading into Friday, sold off on Friday a little bit. So looking for this to continue moving higher. I like this as a trade for the rest of the week. CTLP. Apple back on board because of the news around the Trump administration changing on policy. Looking for a little bit of a rebound today out of Apple. It's up 1.8% today. A good volume weighted average price trade as well. AAPU, the double bull ETF on Apple. If this can get above its 20-day EMA, which we'll talk about briefly, there is upside here for Apple coming off of that sell-off last week. And now that we are away from the headlines around India and now focused on what's going on in Europe, looking for some covering on that. In addition, Procter & Gamble PG back in focus again, above its 50 and its 20-day moving average. Strength across the board, RSI, MFI, ADX looking strong. So again, if I'm trading this, if I'm looking for upside, I'm buying a call somewhere around the 50-day moving average and setting my stop back there. 50-day EMA. I'm going to do a little bit of a switch over on this, and I'm going to explain why right now. Okay, 850. UK race here. Good to see you, Lon Jeff. Hope you're doing well. Trade what you see, not what you think. I just plagiarized someone. Don't remember who. It wasn't me. Maybe it was Don. Maybe it was Gianni. Again, Gianni, the tech reset. Click the link above. And let's talk about SMA versus EMA. Okay, so you know that I tend to focus on the simple moving average, and I do that because I don't have to explain the term exponential. Simple is simple, and I always say keep it simple, but EMA is really the secret sauce when it comes to momentum when we break down individual sectors. So I want you to keep this in mind. I'm not asking you to do any of the work. I'm just going to let you know we're going to pull the Komodo open and we're just going to say, look, this is what we utilize and focus on when looking at individual sectors. So the SMA is an average of closing prices over the last 20 days. Pretty simple, and I like simple. But the EMA is a weighted average, and that is different, right? It emphasizes recent price movements. And in terms of momentum, the EMA and the SMA tend to show us on the 20-day moving average, they typically align perfectly. What do I mean by that? Well, let's just look at the TECL. And once again, when we are looking at the technology stocks, when we're trying to get a sense of what technology stocks are doing in terms of momentum, we can compare the SMA and the EMA. And what you're going to see is that there typically is alignment around the 20-day moving average. And a good example of this is we go back to April 23rd. Now, you know that momentum turned positive on April 23rd. I've said this time and time again. A very important element around this is the fact that technology is the bulk of the S&P 500. When technology stocks are breaking down, momentum in the broader market is typically weak. It just is because of the weight. But I want you to look at this because, again, you could see right here on the 23rd, the simple moving average and the exponential moving average are basically aligned. Same thing happened when we had a breakdown back here. Really the 21st, 24th, however you want to analyze it. But you can see the EMA broke first before we went to the downside here. It really doesn't matter. I'm just going to say that. It really doesn't matter that much. But if you want to be the first person over the wall, you want to be the person watching the EMA. The EMA can occasionally, obviously, break down first, and it can be a bit of a head fake sometimes. You can see there was consolidation here back in February. But you will see, typically, that to the downside, the EMA is usually the first indicator. To the upside, it's usually the simple moving average. More times than not. So when you see the TECL break under its 20-day EMA, you want to be short tech. When you see the 20-day SMA, you see it move above, you want to be long tech. Okay? Like, I can't make this any simpler. I really can't, because this shows time and time again that when this really breaks down, it really goes badly. This is last year. This is last July. And this sell-off, this tech move under that 20-day SMA on July 16th of last year, I couldn't tell you on that day what was wrong. I honestly couldn't. I had no clue why it was breaking down the way it was. Well, we found out 2 weeks later. That was the Nikkei crisis. And we can go back and we can analyze all of these moves to the downside, particularly in tech. Remember, tech is a leading indicator. But if you look here, right, you see that little sell-off here. We wouldn't know why that broke under. Well, let's take a look at the FAS. That is the bull ETF for financials. And again, big sell-offs, EMA, et cetera, et cetera, et cetera. 2023, big breakdown. Well, you know what happened here. You wouldn't have known it back here. 2 weeks before the Silicon Valley banking crisis, the FAS broke under its 20-day simple and EMA, exponential moving average. No clue why. There is no news anywhere before March 7th, 2023 that suggests that there would be a regional banking crisis. And there are individual ETFs for everything, right? Leveraged ETFs that you should follow, because a lot of this is hedging. A lot of this is, again, because we operate in a very highly financialized environment, these leveraged ETFs will make things worse to the downside and stronger to the upside because of the flow of capital involved. So There's the FAS. There's the DPST. This is the regional banking space. And there is a leveraged ETF for it, and the regional banks have broken under their 20-day and their 20-day exponential and simple moving average. I can tell you why right now. That's pretty easy because regional banks hold a ton of U.S. bonds, and those bonds are tied to their yields, and the yields are moving higher, and that drives down the value of the bonds, and that creates pressure on the balance sheets of these companies. Now, when DPST moves above its 20 and 20, pretty good. When it moves under, things go awry. This is not limited to just tech. This is not limited to just regional banks. What else is there? Well, there's the SOXL. The SOXL is the bullish semiconductor ETF for semiconductors. I just said it. It's in the name. But as you can see, move above. This jumped 70% after breaking both its 20 and 20. And again, you don't have to hold it very long. And yes, there is decay in this. But so long as you are just trading around the EMA or trading around the SMA, again, it doesn't matter which one you choose. I choose the EMA. This is how it works. And then if it goes the other way, you bet on the SOXS. And as you could see, during that big sell-off we had, SOXS doubled, went from 24 to 50. You don't know why they're breaking down until they do. It takes 2 weeks typically to find out what is going on. And a perfect example of that, going back to 2022, was this sell-off in June of 2022. Momentum went negative. SOXS went from 455 to 800. This was the largest hedge fund sell-off in 15 years. We did not know why on June 9th the market was selling the way it did. We found out 3 Fridays later, when analyzing the Commitment of Traders report. What about KRE? Well, KRE is not leveraged, but same thing. You're seeing the exact same pattern. You can just memorize the screen real quick and then just type in DPST, and it's the exact same thing. But I prefer to watch the leveraged ETFs because that's where the real momentum is. There's a lot of derivatives tied up in this stuff. There's a lot of leverage tied up in this stuff. I'm interested in where the leverage is because when the leverage pulls out, that's where markets move quickly, right? And we've talked about this before when we look at the Chicago Economic Conditions Index, that when there are shifts in how policy is made, that helps fuel more credit, more leverage, and resultantly fuels the S&P 500 because the Economic Conditions Index, if you flip it over since COVID, it is the exact same chart as the S&P 500. So the EMA reacts faster to price changes than the SMA does. Use EMA for short-term momentum, SMA for broader trend confirmation, relevant for identifying trend reversals and breakout timing. And I stress breakout timing. So if you're looking at the TECL and we break that 20-day, well, then you're going to bring it back down to the XLK because that's what it's doing. It's a 3x leveraged ETF. And then you start trading the highest beta possible out of all of the big heavy weight on the S&P 500 select SPDR ETF. Again, great things happen above the 20-day. Bad things happen under the 20-day. To show you why, again, full transparency, all my academic work. This is what we do. I was having a conversation this weekend with somebody, very prominent financial manager, who just goes, "Why haven't I heard of you?" And I said, "I don't know. It's fine." But once again, we were talking about Bitcoin and how Bitcoin is a measurement of broader liquidity and how you just trade around the 20 and the 50. The EMA. Well, why is that? Because we're such a financialized environment. We have so much algorithmic trading, and we have an addiction to behavioral finance where it is easier to use an anchor than it is to try to outsmart the market. And most algorithms are built around the 20. I hate to tell everybody this. It's honestly this simple. Everyone that I have known who has built machines to trade are doing it around the 20-day EMA, particularly for the S&P 500. But this is 1987. Let's go back to 1987 during the crash. Here is the EMA. Red line is the 20-day. Green line is the 50-day EMA. The blue line is the 100-day, and the purple line is the 200. Well, where would you have sold? I would have sold the first time we got under that 20-day moving average in September, because I would be looking for the exact same thing that happened in March. And I'm going to walk you through this, but here I damn near guarantee it. There was no buying pressure at this point. We squeezed, we popped, we hit the upper band, and then we sold off again. Markets constantly setting people up. If you don't believe that this is how the markets work, well, here's COVID. Same damn thing happened. Broke under that 20-day, and it happened on February 21st, 2020. And it's ominous because that's exactly what happened this year. February 21st, 2025, 5 years to the day. 20-day, 50-day, 100-day, 200-day. Huge breakdown. That's this year. Here's the SMA, the 20-day, the EMA of 50. Nothing good happens under those levels. And someone asked me on Friday in a conversation, well, can this somehow be a negative signal? Is it possible that the market, rallies off the back of, after breaking under that level? Yeah, 100%. Because there could be policy shifts. It can hit oversold. We could see massive amounts of insider buying confirm that it is time to make a move and go back to the upside. But again, no financial crash has ever happened over the 20-day moving average. I can't find one. I can't find you wake up in the morning, the market is at an all-time high, and then we drop 7%. I don't have that on record. Now, yes, is it possible? 100%. We could have something happen with Russia tomorrow. But for the most part, smart money's already out the door. Smart money's already moving. People are already taking profits. The selling has already commenced, and retail gets stuck holding the bag. It is the exact same thing over and over and over. So I want you to keep this in mind. I'm not telling you, I'm not guaranteeing you that a sell-off transpires and it turns into a 20% downturn. I'm just going to let you know that every major downturn that has transpired, and back here in August, this is the Nikkei crash, smart money was already out the door in mid-July. So when we break under that level in the S&P 500, I highly encourage people to hedge their positions, take profits, and reassess their portfolio. Do you own something that you maybe shouldn't own? Do you own something that's very speculative? Do you own crap? Oh, and by the way, the companies that will get beaten up are most likely the ones that are heavily shorted. But when we break above that 20-day moving average, that's what takes us into the possibility of a short squeeze. So let's talk about this real quick. What is a short squeeze and why is it relevant today? Well, today, because we had just had a little bit of selling on Thursday and Friday, concerns about interest rates, concerns about Apple, concerns about what's going on in the broader market, some of those names were beaten up. Now, we just had Space, which is one of the dumbest companies in the history of capitalism, squeezing above after it broke its 20-day moving average not too long ago, right? This company's going bankrupt. There's no doubt about that. I don't even understand the purpose of this. It was a SPAC. They manipulated the market. The insiders got paid. Everybody else got left holding the bag. This was a stock during COVID that, I mean, look at the split adjustment here. 900. This went public at 10. So split adjusted 20-1 at some point. 20-1 share split. But note this, EMA. When these stocks are above their EMA, 20-day EMA, look at the moves. Look at what's possible here. 625 to 780. It doesn't sound like a lot, but these are heavily shorted stocks. So it's typically pretty cheap to go long these names. When they break above that EMA, this was a recent squeeze, particularly around earnings, 293 to 650 in about two and a half, about a week and a half. But looking in this environment, coming after that sell-off last week, stocks moving a little bit higher. So what is a short squeeze? Okay. It occurs when short sellers are forced to cover their positions as prices rise. And it leads to rapid upward price spikes due to panic buying, right? So if we go back to what happened a couple of years ago with GameStop, remember there was a hedge fund that was heavily shorting GameStop. GME is the ticker. And what happened in this environment was that there were a bunch of people on Reddit. There's a whole movie about this, by the way, where he's like, you know what? I'm long this company. The fundamentals didn't matter. He just went pure long. And then resultantly, this stock just rips. I watched a lot of really smart people lose money on this because they didn't really appreciate at the time what was transpiring. We'd never seen this before. We'd never seen a retail army come together before and go after a hedge fund. But what happened was volatility on GameStop went through the roof, and there are traders out there. Their entire philosophy on life is to just sell premium, just selling spreads, doing iron condors, looking to try to take a 3, 4, 5% gain on a very small position. And what happens in that environment? They get wiped out. They are selling, they are picking up pennies in front of the steamroller. That's the terminology. So GameStop squeezed. This hedge fund got destroyed. They had to get a bailout, private bailout. But again, always be aware that when these stocks break above their 20-day, things happen, and they happen fast. And I hate to make it this simple, but it kind of is. How do we know what stocks are the short interest stocks? Well, go to highshortinterest.com. Right now, most heavily shorted stock, short interest is at 61%. Okay, that's outrageous, right? 61% of stocks are being shorted. Kohl's, 47%. GameStop, at its peak, I think was at about 133%. What does that mean? It means that not only were people borrowing the stock in order to short it, but they were not just doing that, they were lending it off. So people were borrowing the stock, paying maybe 3% a month, then lending that stock to someone else who might be willing to pay 5% a month just to short it. You want to watch these names. Beyond Meat. Beyond Meat is up this morning. Beyond Meat is, honestly, Beyond Meat makes me want to be an anti-capitalist. I hate this company. I hate this company. I hate their product. I hate everything about it. They should not be a public company. But I can't deny that when it breaks its 20-day, good things happen. So you're watching Beyond Meat. This company's going to be bankrupt in 2 years. But for right now, you could turn $2.50 into $3. You can turn $6.60 into $7.50, right? 20% moves happening in less than a week, and all of those good things happening above that 20-day moving average. So keep this in focus, because on days like this, you want to combine it not just with understanding that, these beat up names are there, but pay very close attention to the volume weighted average price. You have declared as a professional. Okay, well, that's over. We'll figure that out. BYND. I guess I'm a professional now. Okay, we're going to have to figure that out. We'll have to upgrade that. No big deal. All right, BYND. You've got HIMS. I don't know why people are shorting HIMS. The company's fantastic. AirSculpt, Lemonade, Indy, Pure Cycle, Sunrun, SoundHound AI, Wolf Speed. All of those names are in play. Screen for high short interest, percentage of float. Again, you don't have to do the work. The work's right there, highshortinterest.com. Look for sudden spikes in volume. Once again, analyst upgrades, insider buying, positive earnings. Easiest thing to do is just the 20-day. FinViz, Market Chameleon, Ortex has all this stuff, and I like to trade around volume weighted average price. I'll dedicate Friday to do that. I guess I'm going to have to upgrade my TradingView site to do that. All right. Now, unfortunately, I can't show you the last thing that I was going to do because TradingView wants to make me spend a couple $100 apparently. I think it's this is where it gets really expensive, by the way. Try new screener. I think it's because there are more than one person using this. So I have a screener. I can't do anything with it right now, unfortunately, but I can tell you about technical breakout names. So what I'm looking for all the time, and this is already set up in my FinViz, we are looking for names that are high probability movement, and we want to combine multiple indicators at once. And I go back again to J.D. Henning's analysis on this. J.D. Henning is an academic. His father is Grant Henning. Grant Henning wrote a great book called Picking Stocks by the Numbers. He also wrote The Value and Momentum Trader. Henning focuses heavily on a variety of indicators. He has a deep back. This is a guy who has an MBA, an MA, a PhD. I mean, like he's putting me to shame. But one of the key studies that I had read of his was assessing for a variety of different technical breakout indicators. He had done a study, and his father has written about this, that he focuses on a small number of specific indicators looking for breakout stocks. So here's ALTS, right? For example, I don't know what this company does, but I do know that on Friday, we were moving into very strong RSI, very strong MFI, very strong ATR. ADX had a breakout way back here. He doesn't focus on the 20-day EMA the way that I do, but the focus here, MACD, MFI, RSI, I think he uses the ultimate indicator as well. You can use the ADX. It has a very similar ring to it. But what you're specifically looking for, if you are creating a screener, and this is what we were doing on TradingView until they tried to build, until they want $150 a month, and I'm going to have to pay it so that I can show you what I'm specifically looking for. But again, EMA over the 20, positive MACD right here, move above the 50 level on RSI, move above the 50 level on MFI. ATR is what it is. ADX, positive move. Obviously, the buy was back here. Obviously, no doubt about it. But if you're late to the party and you're not willing to speculate around that EMA level, what you're then looking for is just improvement and strength in the RSI and the MFI. And what you want to see is that move above 60 on the RSI and an MFI that's pushing toward overbought as well, because there's a lot of volume. As you can see, we got overbought 2 times here, back here, and we had a little bit of a sell-off afterward. But once again, you can stay overbought for a while on these momentum stocks. You want to watch the MACD for that negative crossover. When that negative crossover happens, that's where you get out. This is all daily. This is all daily. Daily chart, MACD, RSI, MFI, ADX. And as you can see, when these things align, they all complement one another. And this is the point of his study. So he was looking at, I want to say 25 different indicators, and they included fundamentals, they included technicals, they included some, a variety of things that really had nothing to do with the company. Improving EPS, improving metrics, blah, 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 blah. No. Don't worry about any of that. Only focus on the technicals. And what he showed in his, I believe it was his PhD thesis, was that there was a strong correlation and relationship between the RSI, the MFI, the ATR, and the ULT, that those 4 things lined up perfectly. Now, as I've been building on that, I have found that the MACD and the ADX are also appropriate, as is the 20-day EMA. So I am looking for RSI over 55, MFI over 55, positive MACD, positive move over the EMA. And you create a screener completely dedicated to just those stocks. You set tight stops, and I mean tight. People look at me like I'm nuts when I say, yeah, I'll set my stop at 2% below where I was. 2%. That's the point. Lose small, win big. I want to lose 2% 3 or 4 times, but I want 1 or 2 stocks to go 20, 30, 40, 50% because they catch momentum. And that's it. This doesn't have to be that complicated, guys. Right? This is kind of like what we were talking about with Gianni. You know, as Gianni is preparing for this event that's coming up, right? June 4th is the date that he set. He's setting very tight losses, and he knows he's going to lose. He said 25% of the time, I'm trying to win. That's a really good metric. That is an eat what you kill type of philosophy when it comes to trading. The idea that, look, I'm only going to win 1 out of 4 times. I have to build my risk management around this. Go back to the Kelly criterion. Go back to all the academic work built around this. You're looking for 1, 2, 3, 4 wins, and you can lose the rest of them. You can lose 16 times. I was a goalie in lacrosse, and I watched this weekend with a lot of interest. I went to Northwestern. Unfortunately, Northwestern lost in the championship this week, talking about the women's team. And I will tell you, as a practice player for that team, those girls lit me up. They move the ball so damn fast I couldn't even see it. They shoot mid-70s with precision. Men shoot about 105, but it's just wild. A good save percentage in lacrosse is like 40%. Maybe less than that. The ball is coming at you so quickly, and all you can do is just manage the risk of the game. It's a very tough sport. Lacrosse goalie is, I think, the only position harder than lacrosse goalie is hockey goalie. But I bring it to this that I want my win percentage to be, for me personally, in the 30 to 40% range, because 1 or 2 manageable plays will change the course of the game. Unfortunately, Maryland lost yesterday too. McNerney, the goalie, I think is the best goalie I've ever seen play. Unfortunately, his final game he lost. But again, it's all about risk management. It's all about the way that you approach the game, whether it's lacrosse or trading or anything else. You want to make sure that you know exactly what specific number that you are aiming for to be successful. And if you watch the conversation Gianni and I had last week, he said 25%. Well, if he's saying 25%, he has to manage the risk around that, and he does an exceptional job at it, which is why I really highly encourage you to click that link. What year did I graduate Northwestern? 2004? Dill School of Journalism, baby. 150. I think I'm the only journalist left, except for Evan Ben. Anyway, point being, in this environment, I want you to keep this in mind. You are aiming for a very specific number. You have to pick your number. You pick your number. Gianni went with 25. I'm going with 40%. And then you measure your probability of profit, and you set specific loss and win probabilities based on that. I'm willing to lose 3 to 4% for a 30% upside on something else, because again, it's all math. 1 win at 30% and 3 losses at 3%, I'm beating the market, and that's what matters most. Okay, Ed, I think you're right. I think you're right. I am a kid. Let's wrap it up. I'm going to go outside and play. I'm going to go run in the sun and enjoy the fact that summer is here, in my view, officially. And I hope you all have a wonderful day. Next week, my daughter is going to be out of school. Oof, 7-year-old. So you will get to know her, I promise you, because she is going to come in here and interrupt this show every day. That is what she does, because she gets bored and she's going to want to play FIFA or something like that. And I'm going to have to explain that from 8:45 to 9:20 every day, we do this free show. And I will be back here. Not today. I will be back tomorrow at 8:45. And then again, click the link, get the 3 trades. and check out the conversation with Gianni and I. It's definitely worth your time. I hope you all have a wonderful day. Thank you so much for your time. Commander, thanks. Kay Schaffel Lee, if you went to Northwestern, let me know. I hope you guys have a great day. Take care.